What if I told you the biggest short squeeze in financial history isn't happening in stocks, crypto, or tech? It's happening right now in silver. And if you're not paying attention, you're about to miss a move that could take this metal from where it is today to over $200 in the next 6 months, maybe even $500. I know that sounds insane, but stay with me because the data behind this is absolutely terrifying for anyone caught on the wrong side of this trade. Right now, silver is doing something it hasn't done in over 50 years. It's not behaving like a commodity anymore. It's behaving like a coiled spring that's been compressed for decades, and it's finally starting to release. The last time we saw this kind of setup, Volkswagen stock went from $10 to $300 overnight. One day. That's what a real short squeeze looks like. And according to longtime precious metals analyst Bill Holter and momentum strategist Michael Oliver, silver is setting up for the exact same thing, except this time the stakes are much, much higher. Let me give you some context. In 2008, they sold 1.44 billion ounces of paper silver on the COMEX exchange just to push the price down. That's more than 150% of total annual production. Think about that. They sold more silver on paper than actually exists in physical form for an entire year. And if anyone tells you they know exactly where silver is going to peak, they're lying. Nobody can predict that. But what we can do is look at the structure, the momentum, and the supply-demand fundamentals, and all three are screaming the same thing. This market is about to explode. Silver has already broken out, not just on price, but on the spread, the ratio between silver and gold. This is the signal professional traders watch, and in November, it broke out of a massive technical base that it's been trapped in since 2022. What happened next? Silver jumped from the mid-50s to over 30% higher in just 4 weeks. 4 weeks. And this is just the beginning. Because when you look back at the last two major bull markets in silver, 1979 to 1980 and 2010 to 2011, the real explosive moves didn't happen over years. They happened in quarters. In 1980, silver quadrupled in just 6 to 7 months. In 2011, it doubled and a half in 5 months. And both of those moves were compressed into the final phase of the breakout. We just broke out in November. The clock on this move is very, very young, and most people have no idea what's coming. Silver isn't just going up because of speculation, it's going up because of something much deeper. It's in what they call acceleration mode. This isn't a normal uptrend where you get gradual gains and pullbacks. This is a market seeking a new reality. And when markets do that, they don't reprice slowly. They reprice violently. Here's what makes this different. The silver-gold ratio, the percentage of gold's price that silver represents, has been stuck at around 1% for decades. It's been artificially restrained. But in the bull markets of the past, that ratio exploded to 3%, even 6.5% at the peak. We're in a confirmed bull market now. We've broken out on the spread. So the minimum assumption, and this is the minimum, is that silver will at least match those old highs. If silver just goes to 2% of gold's price, and gold is sitting at $3,000, you're looking at $60 silver. But if we match the old bull market highs at 3% and gold goes to $5,000 or $8,000, which is entirely possible given the monetary conditions we're in, you start to see how $200 isn't crazy at all. It's conservative. And here's where it gets really interesting. Gold has had two eightfold moves in the last 50 years, from $103 to $850 in the late 70s, from $260 to $1,220 in 2011, 8 times each. Right now, gold has only done a fourfold move from its 2015 low of $1,050. We're at $3,000 today. If gold does what it's done twice before and goes another eightfold, you're looking at over $8,000 gold. And if silver goes to just 3% of that, you're at $240. If it goes to 6% like it did in 1980, you're over $480. And that's assuming gold stops at $8,000, which it probably won't. Now, some of you are thinking, okay, this is all theory. What about the real world? What about supply and demand? Well, that's where this gets even more intense. Silver has been in a structural deficit for the last 5 years. That means demand has been higher than supply consistently year after year. This year alone, global demand is around 1.3 billion ounces. Production, only 850 million ounces. That's a deficit of 450 million ounces. And it's been like this for years. Where's the missing silver coming from? Stockpiles, reserves, and those are running out. Here's the kicker. The biggest new sources of demand are just getting started. AI data centers can't be built without silver. Electric vehicles are now using a kilogram of silver per battery. That's 32 ounces per car. Solar panels, 5G infrastructure, advanced manufacturing, all of it requires silver. And the problem is the mining industry hasn't kept up, because for decades the price was suppressed so low that it wasn't profitable to open new silver mines. Most silver today comes as a byproduct of mining other metals like lead, zinc, and copper. There are very few pure silver mines left in the world. So even as demand is exploding, supply is constrained, and it can't scale up overnight. But there's something even more critical happening right now that almost nobody is talking about. The market is splitting in two. There's the paper market, where futures contracts trade on exchanges like the COMEX and LBMA, and then there's the physical market, where actual metal changes hands. And for the first time in history, those two markets are completely disconnected. The spot price of physical silver in the East, in China, in India, is trading at a massive premium to the paper price in the West. We're talking $7, $8, even $10 per ounce higher. That should never happen. In a normal market, arbitrage traders would step in and close that gap immediately. But they're not. Why? Because they're afraid they won't get delivery. They're afraid the paper market can't actually produce the metal. This is called backwardation. It means the spot price is higher than the futures price. It signals one thing: scarcity. People want their metal now. They're not willing to wait 30, 60, 90 days. They don't trust the system to deliver. And when that happens, when physical demand overwhelms paper pricing, the paper market collapses. Prices don't just rise, they gap up, they explode, because suddenly everyone realizes the emperor has no clothes. The Western exchanges have been selling silver they don't have. And when the squeeze comes, when the shorts are forced to cover, there won't be enough metal to go around. China has already announced they're cutting off silver exports after January 1st. Chinese and Indian companies are going directly to miners in Latin America, buying up ore before it even reaches Western refiners. That metal is leaving the system. It's going to China, being refined there, and it's not coming back. Meanwhile, Western exchanges are sitting on massive short positions they can't cover. The fuse is lit. The only question is how fast it burns. Jim Sinclair, a legendary gold trader, once said he envisioned a day when COMEX gold would be offered at $10 an ounce with no buyers, while China would bid $50 an ounce with no sellers. That's the ultimate bifurcation. That's what happens when paper markets lose all credibility, and we're seeing the early signs of that right now in silver. This isn't speculation, this isn't hype, this is structural, this is real, and it's happening in real time. So what does this all mean? It means we're not at the end of a move. We're at the beginning. The November breakout was the signal. The momentum is confirmed. The supply-demand fundamentals are the worst they've ever been. The paper market is losing control, and when this thing goes, it's going to go fast. A minimum move to $200 in the next 6 months is not just possible, it's probable. And an overshoot to $400, $500, maybe even higher before it settles back, that's entirely within the realm of reality. Because when markets correct for decades of suppression, they don't just go back to fair value. They overshoot, they overcompensate. That's how markets work. If you own silver, hold it. If you've been thinking about it, the window is closing fast. Because once this move really accelerates, once the shorts start panicking, once the physical premium explodes even wider, there won't be time to react. The greatest short squeeze in history doesn't announce itself with a press release. It just happens. And if the data is right, it's about to happen in silver.